So let's bring in Jeffrey Gundlach now, the CEO, CIO, co-founder of DoubleLine Capital. Jeffrey, it's good to see you. Welcome back.
Nice to be back on Fed Day, Scott.
Yep, and it's good to have you. First and foremost, your reaction to what we just saw.
Well, I think you just said the most important word, which was unlikely. Unlikely the next policy move will be a hike, and he went quite out of his way to make it sound like they're not contemplating a hike at all based upon the data that's come out, even though he's being a little bit disingenuous by claiming that inflation is below 3%. Remember back at Jackson Hole in 2022, I think it was, we came up with supercore inflation, supercore CPI, supercore PCE, and supercore PCE, which is excluding food, energy, and housing, is up 3.3% year over year. And what no one wants to talk about is supercore CPI is up 4.8% year over year. In fact, the CPI for the first quarter here in 2024 at year end was projected to be 2.7 on an annualized basis. Instead, it's 3.5 year over year on the headline. So it almost feels to me like he's hoping that the inflation data comes down without a rate hike. And I guess he feels that the lack of progress, as he framed it, during the first quarter is going to be transitory. So we'll see. With oil prices at $80 a barrel, I'm not really sure we're going to see the inflation numbers come down in a sustainable way below 3%, particularly not on the core numbers. So the markets, as you correctly pointed out, love this because there was fear of a lurch toward some suggestion of maybe contemplating a rate hike, and that absolutely did not happen. And so you just saw everything go vertical to the upside. You know, stocks went up a lot, junk bonds went up a lot. I mean, we had corporate bonds and emerging market bonds down earlier in the day, and they're now significantly in the green. So this is a interesting thing because the big pivot that started everybody getting happier was November 1st. And interestingly, rates are up a little bit since then, but not very much since then. So we've basically had rates go up and then come back down and go back up again. We've definitely been in a trading range for the fixed income markets and more recently sort of the equity markets as well. And this meeting and this press conference suggests to me that that's going to be sustained.
It certainly sounded like I guess we could say, a not yet chair versus a not at all chair, at least when it comes to rate cuts. I want to note going in that Goldman is still sticking to its view of 2 cuts because they say the 2 pillars of disinflation are intact, those being lagging housing data and the fact that we don't have any more supply shocks. I'm curious as to what your take is now. When do we get the first cut, and how many will we get this year?
It seems unlikely that we're going to get 3. That was in the Fed's dot plot back in March. I actually, based on what we're seeing in the inflation market and commodity prices, which have been weak recently, but they're pretty much at their 200-day moving average, oil is up. I kind of feel that the base case now is 1 rate hike for this year.
Cut.
And I certainly don't think it's...
You mean cut?
Sorry, yeah, cut. Yeah.
Freudian. It's a Freudian slip.
got it backwards. But I don't think it's coming in June. I just don't see how that could possibly happen. There's just not enough data, and he certainly respects the fact that, I mean, lack of progress on inflation. That was not unanticipated that he would say that because he can't disrespect the data. I mean, it is what it is. But I thought one interesting takeaway that I got was he mentioned that a couple tenths in the unemployment rate would not be a catalyst for easing. I had the feeling that he needs the unemployment rate to get up to 4, maybe 4.2 even. And so we'll see what happens there. The unemployment rate has been up a little bit, but clearly it's not to the point where the inflation fight is less important than as the dual mandate, because the jobs part is behaving quite well, and the inflation rate clearly is the one that is lacking progress, as he put it. So I'm going to lean on one rate cut this year. I certainly don't think 3 seems very likely at all. So that's where it is. I think that higher for longer seems like the mantra continues, but without a rate hike. So this is a pretty good environment. The type of strategy that we've been advocating and implementing seems like it's going to keep working. It's been working really well for the past 6 months. And that is, that you can get pretty good yields by investing in securities in the fixed income market that aren't that risky. I'm not talking about triple C junk bonds or even single B junk bonds. I'm talking about things like single A, triple B, maybe high double B, that are priced off of the short end of the curve, or say off the 2-year or the 3-year part of the curve, where you can get yields that are in the mid-7s without a lot of risk. And that seems like it's going to be a very comfortable place to invest without a lot of volatility. So you want to take advantage of this inverted curve, which has been inverted for a very long time now. It's one of the longest inversions in the history of the bond market in modern times. And it looks like it's going to continue for a while. So that means that you can get decent returns without a lot of lost sleep by staying in some credit securities, but really pricing off the short end of the curve. So we've liked bank loans in the double B area. They continue to do well. We like consumer receivables, parts of the commercial real estate market, away from office. These types of things can all generate 7.5%, even 8%, depending on how much risk you're willing to take. And once again, with some uncertainty having developed, maybe it's going away now with this Fed meeting today, but for retail investors, closed-end funds have gone back to trading at discounts broadly, and with some leverage involved there's double-digit yields available without taking a ton of credit risk. So this seems like a pretty good environment for moderate risk assets, and it seems like we should probably not have a terribly volatile environment before the next Fed meeting, which I know you're coming out to DoubleLine for the next Fed meeting. It'll be fun to do it in person.
Yeah, I'm looking forward to that. What about the shorter end of the curve, maybe the belly of the curve, even if you think that, Powell's all but telling you without saying it that they think the next move's a cut, right? They're pretty much alluding to that. It's just a matter of when. So if you think that rates are going to go down later in the year, what about treasuries now?
Well, I don't really like the long end of the Treasury curve right now. We had been owning some long-term Treasuries. They rallied a fair amount from October. And now we're more interested in, say, the 10-year than the 30-year Treasury, and liking the belly of the curve, as you say, pretty well. And pricing and assets that are priced off of the 2-year and the 3-year, you don't have to go into junky credits. You can get the yield of the high-yield bond market to a no-default scenario, basically, in single A securities that are priced off of the 2- and 3-year part of the curve. So that's what we really like. We haven't had a lot of changes in our portfolios since last we spoke, Scott. We've shortened our duration a little bit because we thought rates were a little bit too low, and the 10-year got into the 3s, as we suspected was going to happen. But now that we're up at 4.6, and we lost the 5 handle on the 2-year after the Fed meeting, but those are pretty attractive returns for the risk that you're taking, and the volatility just hasn't really been there. Since November, the volatility in the bond market has pretty much dissipated. A couple of years ago, rates were 200 basis points lower than they are today, but they've certainly plateaued. We're basically, in many parts of the curve, very close to where we were, really been in the range for the past 6-7 months. So it's a low-risk environment, and it's appropriate that we got a big equity rally, because everyone was scared that the Fed might mention a rate hike, and that absolutely did not happen. So I think we have to characterize the Fed today versus expectations perhaps yesterday as being incrementally dovish.
Jeffrey, I'll turn back to you. The other moment I think that people are calling a moment was Powell addressing the S word, stagflation, to which he said, I don't really understand where that's coming from. I don't see the stag or the flation. What's your take on that?
I agree with him. I really don't understand people talking about stagflation at this moment. I actually heard somebody on the radio earlier this week actually say that the economy is shrinking and inflation is going up, in real time in a measurable way. Obviously the economy is not shrinking. 1.6 GDP isn't great, but it's certainly not shrinking. And we see that the GDP now for the second quarter, although it's very early, so it'll probably get revised substantially, but it's up in the high threes. So the economy is not shrinking. And the inflation rate, it might be at 3.5%, but that's not exactly Jimmy Carter inflation. That's not 2022 inflation. Inflation is clearly less. Now, the thing that is, I think Powell is onto correctly is I think everybody, myself included, thought that shelter inflation, rent inflation, would come down faster than it did. Because the Zillow index and the apartment rent indices, they came down multiple percentage points, and they're down in the 2s, 3s, and 4s, having been up in the 8s and 9s, but yet the owner's equivalent rent stays remarkably high. We got some home data yesterday, and it said that home prices were up, depending on what zip code and what district you're in, but something like 5 to 8%, which sounds surprisingly high given the low volume of turnover and the interest rates. But maybe it's a mix shift. Maybe the data, maybe it's higher price homes are selling. That would actually make sense because it's the lower middle class and the middle class that's really getting buried by this inflation. And these prices, while the inflation rate isn't that high, the absolute prices are still high. And we have weird things going on, like insurance prices are up massively, which are one of the reasons why the CPI is so much worse looking than the PCE, because we don't have in the core area these insurance prices, and the shelter prices in the PCE are substantially lower weighting. So where I am right now relative to the Fed is I'm going to be looking very, very closely, as closely as you can possibly look at monthly inflation data, and I'm going to be following the oil prices, and I'm going to be following commodity prices broadly, which had shown some strength but are now easing off, and it's nice to see oil back below $80. But if we see 3 4/10 inflation prints, it's going to be very difficult for Jay Powell to make the statement at the next meeting that he's going to get inflation down to 2%, and yet there's no need for any rate hikes. It's going to be difficult to call this inflation reversal or lack of progress transitory come the June meeting, and certainly the one after that. So that's going to be the story, I think, for the second part of the spring into the summer of 2024.
You know, if you listen to Powell's tone and if you read into the demeanor and such, he definitely comes off exuding this confidence that he still thinks they can pull this off. And this being the soft landing, because he does expect that growth is going to remain strong enough and inflation later in the year is going to get down closer to target. You've been looking for a recession, albeit suggesting it was, getting pushed out. Do you still hold to that call, or are you changing that?
I am on the fence as to whether we'll get a recession in 2024, largely because the unemployment rate has been so stable. I would be very concerned if the unemployment rate went up by another 3 or 4/10. I think that would lead to a recession sooner rather than later. But we haven't had that happen yet. In spite of the fact there's been all these layoff announcements, it is weird that the weekly unemployment claims never change. Here we have this economy that has its ebbs and flows, and yet we get the same on Thursday. We get the unemployment claims, and they come out almost exactly the same every week. My friend Jim Bianco wrote a piece on this, saying this is almost statistically impossible. What is going on here? That it's always 212,000 unemployment claims every week. But those are the numbers, and unless there's something wrong, and they're going to be adjusted very substantially, and there is some evidence for that. I mean, there is data that's a lot weaker. The household data is a lot weaker than the establishment data. There's this BED data that tends to lead the establishment survey, and that's looking strangely weak compared to what's been happening in the establishment survey. But for now, those layoffs don't seem to be. They seem to be offset by hiring. So we have a labor market that's in balance, even though it seems with the inverted curve and how long it's been inverted and these higher interest rates, you would think the economy would have weakened. But we still have all of those distortions from the COVID response. There's still a huge M2 supply. It's still way above the trend that it would have been if we hadn't bulged up the M2 in 2021, 2022, we'd have had much lower M2 supply than we have right now, even though it's not really growing robustly anymore. So a lot of these things got way out of whack, and it's taking longer. And Powell acknowledged it himself, and I give him credit for that. That this normalization is taking longer than anybody expected, including myself and including Jay Powell. So I think we need the unemployment rate to go up, and it hasn't really happened yet. So that's number two. Number one is the inflation data. That needs to come down, and I don't really have Jay's confidence that the inflation rate is going anywhere close to 2% by the end of 2024 on a year-over-year basis. I don't care what you look at, whether you look at core or super core or PCE. I don't see any of them going to 2% this year.
I mean, on that note, do you take the Fed chair at his word that it's 2% or bust? Or do you think that they'd actually be willing, even though they're not going to say it, to accept a higher target now rather than what the alternative might be, and that is to ruin a good story that they'd like to be able to tell?
I think that he's doing a little sleight of hand with his inflation numbers, as I said earlier. He's making the claim that the inflation rate is in the 2%, 2.7. He cites the PCE, and many other inflation measures are in the 3s or 4s. And you'll remember the 3-month annualized trick that was behind the rhetorical pivot back November 1st. I mean, no one wants to talk about 3 months annualized now because it's not pretty at all. We had CPI come in 0.8 higher in the first quarter on an annualized basis than what was anticipated just 3 months ago. So I think that he's going to have to hike rates unless this transitory lack of progress reverses. And I don't have the same level of confidence that he has that that's going to happen.
And even with all of that, I think one of the headlines, my takeaway, at least from my conversation with you, is that Jeffrey Gundlach is bullish on risk assets, at least in the near term.
Moderate risk assets. I don't like really risky stuff because I think higher for longer is going to start taking some of the bodies out. But I do think that in the medium risk assets, I am positive for at least into the next meeting.
Okay, where would you put equities, for example, on your scale?
I think I'm sort of neutral on equities, but I have a very I don't like index fund approach at this time. I continue to like sort of Japan, Mexico, India as long-term holds, and I'm not a momentum guy, and I know that momentum has been a winner for the past 18 months at least, but I think it's not really leading the way anymore, and I just think valuations, while not excessive, I think they're on the rich side, and they really kind of need this Fed story to play out. But I think in the near term, we at least have the wait and see. We have the time on our side because the Fed has supported a lower volatility environment, I think, for the next several weeks at a minimum. Speaking
of momentum things, gold, you talked about oil for a minute, right? We seem to be on this march, towards 90. And then the dollar. How about your outlook for all three before I let you go?
Well, I've been bullish on gold. I talked about it in our roundtable prime here at DoubleLine the first week of January. I didn't think we'd go up so quickly. I mean, it went up to 2,400 in the blink of an eye. That's a pretty big run. But I would hang on to gold. I wouldn't be a seller. I'd probably wait for more like 2,200 to be a buyer. But I think that's fine. I think the dollar is going to weaken, but it needs the recession to weaken. And in the near term, the dollar appears to be stable, very stable, versus most other developed currencies. So I don't have much of an opinion on the dollar. And then what was the other you wanted to?
Oil.
You said oil seems very, very stable at about $80. I think that if oil went to 90, as you suggested it might, or certainly to 100, the Fed's going to have a really big problem. So that's the biggest wild card out there in kind of the uncontrollable commodity markets. If oil puts on another $10, $15, $20, there's no chance you're going to get to a 2% inflation rate, as Jay Powell is hopeful for.
Jeffrey, we'll leave it there. And the next time we meet, we'll be in person, as you say, at DoubleLine in Los Angeles after the next meeting. I look forward to that.
Okay, sounds great. We'll have a good time.
All right.
Good luck,
You be well.
everybody.
Thank you. We'll see you then. Jeffrey Gundlach.